Hi everyone, welcome to my new YouTube channel which is exclusively for commerce students. Count on Me is my channel name and here I will be dealing with different topics in commerce. I have attempted to make it as simpler as I can in order to help even the beginners understand the basics of every topic I teach here. As the name rightly says, you can count on me when you have doubts at the below given email ID. So, to set the ball rolling, let me begin with the first topic, which is fundamentals of accounting. I wish you all a very happy learning. The objectives of this class are to understand the basics of accounting, to develop thorough knowledge with regards to the important and basic terms or terminologies used in accounting, and to familiarize with the steps to be followed while preparing books of accounts. In order to begin with, let us look into the meaning and definition of accounting. Accounting is the language of business. It is through accounting business communicates with its stakeholders. It helps to evaluate the financial status or position of a business during a particular period. Just like how we need a language or a medium to express our thoughts and ideas to another person, a business also needs a language to communicate its day-to-day activities with the one who are running it. Accounting is that language by the use of which business communicates with us. Let us look into the definition of accounting. Accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of a financial character and interpreting the results thereof. The definition gives us a fair and clear understanding of accounting. In order to familiarize it, we need to understand certain terminologies used in accounting and the steps to be followed in accounting. Let us look into the steps in accounting. Accounting comprises of 5 major steps, which are recording, classifying, summarizing, analysis and interpretation, and communication. We will go through each step in a more detailed manner. Recording. Recording is the first step in accounting. Transactions are recorded initially into the books of accounts. It is done using journal. The process is termed as journalizing and the end result is known as journal entry. The activities of a business which helps it in achieving the intended income or revenue are recorded in the books of accounts. The process of such a recording is done initially to a book called journal, which plays as a chronological record of all the transactions done by the business during the period. The second step in accounting is called classifying. The transactions which are initially recorded in the first step are grouped into different accounts of similar name. The process is called posting and it is done in a book called ledger. Once the recording is over, the next step in accounting is classifying. Here, transactions of similar nature are grouped under a same head called accounts. Thus, it helps us to identify all those transactions pertaining to a specific person or entity to find easily. The third step in accounting is called summarizing. Here, in this step, we will group all the accounts created in the second step based on their similarity. This is usually done at the end of a financial year and is done in a separate sheet of paper popularly known as trial balance. Analysis and interpretation is the step where collected information are examined in detail. Income and expenses are set off to arrive at the profit or loss, and assets and liabilities are balanced to know the position of the business. Once we summarize and group all the accounts based on their nature, the next important step is to analyze or study the result to arrive at an inference or idea about the performance, stability, and future prospects of the business. This is done by preparing the financial statements of the company. A financial statement of the company gives us a clear-cut understanding about the position, the profitability, and the future prospects of the company. Communication is the final step in accounting. In this final step, the information that we analyzed and interpreted in the previous step is communicated with the stakeholders. This is the major reason for which accounting is developed. A financial statement prepared and presented does not serve its right purpose until it is communicated effectively. Accountant or such other person so authorized will communicate the important aspects of the prepared financial statements. This will help the interested parties or stakeholders such as government, shareholders, employees, etc. to get a clear-cut idea about the working of the business. The most important objective of accounting is to provide information to the users, so to enable them in taking crucial business decisions. The primary objectives of accounting are as follows. Maintenance of records. As we stated in the definition itself, accounting is done to maintain the records of transactions which are financial in nature and to arrange them into separate heads like assets, liabilities, expenses, incomes, etc. This is done using the books like journal, ledger, and trial balance. Determination of profit or loss. Once the data is recorded, the accounting helps in finding out whether the business is earning profit or is it going through loss. It is done by setting off the income earned and expenses incurred during a particular period. Depiction of financial position. By preparing a position statement called balance sheet at the year end, the business evaluates the asset that it owns and liabilities that it owes, making accounting information available for various interested parties. The final objective of accounting is to make accounting information available to various interested parties. The result so obtained from the records prepared, analyzed, and interpreted are communicated with the interested parties so to help them in developing decisions. Characteristics of accounting. The objective of accounting is to provide information about the financial positions, performance, and changes in the financial position of an enterprise to the users of such information. The accounting information, therefore, should possess the following characteristics. Reliability. Reliability refers to the trustworthiness or authenticity of the data being provided. It states that the accounting information collected must be free from errors and bias. It helps the users to draw accurate inferences from the information provided to them. Relevance. The accounting information must have the characteristic of being relevant. That is, only necessary information must be provided to the users. Any unnecessary information provided will create confusion among the users. It also states that the information must be supplied timely. Comparable. The third characteristic of accounting is comparability. Inferences or conclusions can only develop when it can be compared with some other similar business or that of a previous period. Comparability thus plays a vital role in preparing a financial statement. Understandability. Understandability is the most important characteristic of an accounting information. The data collected or information derived out of it does not play its role unless the user can understand the meaning. Accounting information, therefore, must be simple and easy to understand. Now, let us familiarize the basic terms or terminologies which are fundamental to understand accounting, many of which have already been introduced to you in the past slides. But it is necessary that one must need to have a thorough knowledge in the terminologies to understand accounting completely. So let us look into the basic terms or terminologies of accounting. Business transaction or financial transaction. It refers to the exchange of money or money's worth as goods or services between two or more parties. Transactions or business transactions refers to the activities carried out by a business to earn intended revenue. It includes purchase of material, sales of material, payment of expenses, etc. Purchases. Purchases is the total amount of goods procured by a business either on cash or on credit basis for the purpose of resale. It denotes the cash or other valuables paid or expended for the purpose of acquiring goods which are meant for resale. A retail textile owner purchases shirts, pants, etc. for selling it to the customers is an example of the same. Sales. Sales denotes the income earned from the sale of goods or rendering of services. When a business sells its goods or render services to any other person, the income derived from it is denoted by the term sales. Expenses. Any amount spent in the process of earning revenue is termed as expenses. Expenses are thus the amount that we spend for earning revenue. Telephone charges, electricity charges, etc. paid can be termed as expenses, and these are normally recurring in nature. That is, it will happen often. Losses. Excess of expenses over income is termed as losses. When expenses are higher than the income we received, that situation is termed as loss. Sometimes we may spend more to earn little. The difference between the expense and the income is thus termed as loss. Stock. Stock denotes the goods available with the business for sale on a particular date. Goods or products purchased but not sold to the customers are stocks. Stock is the difference between goods purchased and sold during a year. Debtors. A person or persons who owes money to the business is known as debtors. A debtor is a person or an entity who or which is liable or responsible to pay you any amount borrowed or received from you. Creditors. Creditors, on the other hand, denotes people to whom we are accountable. These are the people from whom we may have borrowed money and are responsible to pay back. Assets. Cash or any other valuables owned by the proprietor is known as asset. These are the properties of the business. Land, building, machines, vehicles, etc. that are in possession of a business are known as assets. The assets can be broadly classified into two: fixed and current assets. Liabilities. Claims of outsiders against the assets of the business is normally termed as liabilities. Liabilities, in simple term, represents or denotes the obligation of a business to another person or business. A deferment of payment of any expenses for a later period can be termed as liability. It is termed as liability or considered as liability until and unless the said amount is paid. Capital. Any claim of the owner against the assets of the business is termed as capital. Capital is also a kind of liability. It denotes a liability of the business towards the owner of the company. It is also referred to as the amount invested by the owner in a business. Drawings. Cash or any other valuables taken away by the proprietor for his personal use is termed as drawings. Drawings denotes the withdrawals or takeaways made by the owner of a business from the capital contributed by him or her. It can be either in the form of cash or in the form of assets. Let me just recap very briefly what we learned here today. In this class, we learned the meaning and definition of accounting, the need of maintaining accounts, basic terms which are crucial while learning the accounting, steps to be followed while preparing accounts, and the qualitative characteristics which distinguishes accounting from other forms of arts. Hope you all enjoyed this lesson. Please give your valuable feedback and suggestions to the below given email ID. Please like, share and subscribe if you like the video.